Welcome back to the channel. I hope all of you are having a great day. So today we have to talk about why big banks are so awful and why they are going to be responsible for why this recession is going to be just as bad as 2008, if not worse in terms of a collapse. A very big event coming up this week on Friday, October 7th, and how that will play into the markets in the short term. And of course, some data that correlates with all of that to help you guys understand what's happening in the markets. So before we get started, if you guys could definitely go ahead and smash that like button and subscribe to the channel for more daily content just like this. And also in the comments, leave down below what you like and didn't like about the video. So today's video is going to be packed with a decent amount of charts, some data, and some important things for you guys to understand because down the road this could have massive implications. But let's talk about the short term first. Now, the first thing that I want to talk about is the important event coming on Friday, October 7th, which is going to be the United States unemployment rate. Now, this is going to be very, very important because when you're looking at the data, the previous data point for unemployment was 3.7%, and they're forecasting that unemployment is not going to rise. So depending on how this number comes out is going to be very important. If the number comes out above 3.7%, that is very bad for the markets because higher employment means a recession is definitely coming. Now, I know what you guys are thinking. We're already in a recession. I don't know what you're talking about. Trust me, you're preaching to the choir. But as far as the Fed is concerned, and a lot of economists, as long as unemployment is low, we are technically not in that recession. And if we go over here to the unemployment rate on the data or the charts, when you're looking at the unemployment rate compared to a lot of the other recessions, I mean, if we go all the way back to basically the early 1990s, unemployment is also followed by a recession. So when we have high unemployment rates, what we're also looking at is recessions leading right after that. And it happens over and over and over again. And that's what a lot of economists are having a struggle with, is that they can't really say that we're in a recession because unemployment is so low. But if we zoom in, if unemployment starts to go higher, there are then risks that unemployment is going to get to the point where the Fed is going to step in and basically be like, yes, now we're in a recession. And just in case you're kind of new to the macroeconomic world and everything that's happening, the reason that the Fed is raising interest rates that is causing a possible unemployment rate to rise or slow in the economy is again because of inflation. Their main goal right now is to bring inflation down because they don't want to ruin the purchasing power of the United States dollar, especially because that is the only currency, or the fiat currency, that is actually doing well in the world when you compare it to everything else. But if you take a look right here, it is looking, and again, this is very short term, it could switch up on us very soon. But what it's looking like is that inflation rate is going down because last month it was at 8.7%. Now we're 8.3, and if month after month it continues to go down, that's an extremely good thing because when you look at unemployment, the odds are is that unemployment rate is going to rise because again, that is a very lagging indicator, and we've already been seeing, big companies laying off employees, and we have a ton of zombie companies that are probably going to go out of business, which is going to hurt the workforce by the thousands. And again, whether you like it or not, the most important chart or the most important data point that you can really pay attention to during 2022 and 2023 are the interest rates. Now, this is really what dictates what's happening with unemployment, inflation, the markets, everything. As long as the Fed continues to raise interest rates at a record pace, which they have, then we're going to see the markets become more risk off again and the markets continuing to fall. Now, the next FOMC meeting is November 2nd, so that's going to be a very important one. But what a lot of people and investors are pricing in is that we have another 75 basis point rate hike, which would bring us to 4% right around here. Now, a lot of people are thinking that the terminal rate, or the rate at which the Fed stops increasing rates, is in between 4 and 5%. So this could be an area right around here, 4 to 5%, where the Fed basically stops raising interest rates, which again could slow the turmoil and the downward pressure in the markets. But until they actually stop raising rates, or they pivot back to the downside, or begin, stop the quantitative tightening, we're just going to see the US dollar continue to gain strength, especially as other currencies like the Great British Pound, the Japanese yen, and the euro continue to lose value. More countries and more people are going to be jumping into the US dollar, giving it that strength. And again, as the DXY, or the dollar, gains strength, almost everything else is going to lose value in terms of Bitcoin, in terms of gold, in terms of stocks, risk on assets, things like that. But one interesting thing is that if we look at the monthly RSI, anytime that we've gotten in the overbought area right around here, we can see that the DXY does pivot and start to fall. Now again, one thing to remember with this is that we are in the monthly. And while yes, the first time that we get into this area, we still do have time to rise to the upside. Like the first time we were in the overbought area was right around here, and we still had some time to rise. We were in the overbought area right around here, and we had some time to rise. So while we're in the overbought area right around here, that does mean we still have some time to rise, maybe getting to those early 2000 highs of 120 points. And again, if we continue to raise interest rates for at least another, let's say 1 to 1.25% from where we're at right now, then that definitely gives us the opportunity to get a stronger dollar, which in the end basically translates to a lower Bitcoin, or lower risk on assets. And when you look at the weekly chart of Bitcoin, you just have to look at this as a possible squeeze. What we've seen is that whenever price starts to coil up, or there's not a lot of price action, price tends to either go back to the upside or the downside in a violent manner. And with all the turmoil and all the craziness happening, and interest rates continuing to rise, my money is definitely on the downside into this blue area. If we look back, these are pre-pandemic levels, and again, the 2018 bear market levels as well. So if I were to put any opinion into this market, I would definitely think downside is coming, because this is just too obvious of a floor. And that's exactly what happened right over here in 2018, right at 6,000, and then we broke that floor. That's exactly what's happening over here. We have this very obvious floor, and it looks like we could be breaking it. Now, getting away from the charts and a little bit more into, further looking things that could be happening that could also bring more downside into the markets, is that Credit Suisse has some turmoil in terms of, one, their stock, and two, possibly being margin called on all of their credit swaps. Now, just in case I lost you there and you don't really understand what's happening, their credit default swap levels are at one of their highest ever. And basically what that means is that, imagine you're a degenerate day trader and you're just leveraging your money in the markets too much, right? You have $100, then you use like 101 leverage, and you're close to getting margin called, which basically means you cannot afford to go any lower in terms of price or in terms of your investment. And so your broker is going to just margin call you, which basically means they're just going to take the money out for you to make sure you can pay off your debts. Now, usually that's pretty common in terms of day traders or people with, smaller accounts. Now, imagine a massive European bank doing that with trillions of dollars. They are still doing the same thing that, degenerate traders are doing, but with just larger capital, and it has larger implications. Now, what the market is saying is that in the next 5 years, there has, almost a 23% chance that they do default on their debt in terms of this. And if we take a look at the chart right around here, back in 2008, these were the levels that they were at. And again, remember the Lehman Brothers, the company that said that, hey, we have enough money, like you guys don't have to worry about us. We're not going to go bankrupt. We're not going to go, out of business. And then they went out of business, and there was over $600 billion that were, loans that were defaulted on, loans that they couldn't pay. And that's what really crashed the economy, along with a lot of other things. Oh, we're getting back to those 2008 levels. And when you take a closer look, the Lehman Brothers was very bad as they defaulted on $600 billion. But when you look at Credit Suisse and Deutsche Bank, which are currently getting back to those 2008 levels, they're holding around $2.8 trillion, which is almost 5 times more than what the Lehman Brothers had. So if you could just take that and wrap your head around it, imagine if Credit Suisse and Deutsche Bank do get into that troubled water and possibly get very close to defaulting, because they are getting close to those default swap rates, which if they end up defaulting, I mean, this could absolutely crash the markets like we've never seen before. And again, this is not just a Credit Suisse problem, this is a global problem. Every single country. I mean, if you look at the global debt as a percentage of the GDP, you can continue to see it rise. I mean, during the pandemic, it just hit massive record levels, and then we kind of started to wane off, but now it looks like we're coming back to the upside. And as debt becomes a little bit more expensive and debt becomes more of a percentage of the GDP, that's just showing that, countries, not just the United States, cannot pay off their debts, and maybe we start to default on them. And just to point out, I mean, when we're looking at the percentage of the debt compared to GDP, we are above 300% already. So we already have 3 times more debt, almost 4 times more debt than we actually do productivity. Now imagine if that was a business. That business would definitely not last much longer. And the last thing that I want to bring up for Bitcoin's price is that when we're talking about price and we're talking about capitulation and we're talking about downturn, we also have to talk about the hash rate and the miners, because that's one major aspect of Bitcoin's entire existence, is the miners. And when we're looking at the hash rate, it's currently at its highest that it's ever been, which is really good because it means that the network is the most secure that it's ever been. But there also needs to be somewhat of a miner sell-off. And as we take a look at past prior action, whenever we look at the bear markets, usually within 6 to 12 months later, there is a major capitulation of the hash rate from its all-time high. As you can see here in 2018, that bear market, it fell around 35%, right around the COVID pandemic, around 52%, and currently we're only at 17%. So we could still have some more room come to the downside in terms of hash rate capitulation. And if that happens and the price continues to fall, that means the miners will have to sell out, because they do need to sell their Bitcoin in order to turn over that profit to keep business running and keep those nodes running. So that is definitely something to keep in mind in terms of the next, 6 to 12 months. But that is everything I have for this video. I hope you guys enjoyed it. I hope you found some value from it. And if you did, make sure you leave it in the comments down below what you liked, what you didn't like, and what we could do better for the next video. But in terms of what's going on in these markets, I hope that you guys stay informed, think long term, and think objectively, because nobody really knows what's going to happen next. All we can do is look at the data and hopefully understand and prepare ourselves for, what might happen. But until the next video, I'll see you guys then. Peace.